Hi, everybody. Dave Fry, ETF Digest. I have the pleasure of having Dan Dolan with us, who's Director of Wealth Management for Select Sector SPDR Trusts. Dan, how are you?
I'm good, Dave.
We feature virtually all the sector SPDRs every day in our daily commentaries. Certainly we use them off our main menu at the ETF Digest. We use them in the portfolios as well. There are 9 sectors. You want to go over them briefly?
Sure. All we really do here is take the S&P 500 and carve it into 9 pieces. So if you own all 9, you own the S&P 5. But what Sector SPDRs allows you to do is to take the slices of the S&P 500 that are appropriate for your portfolio, or weight the S&P 500 any way you like. So sectors like energy, financial, healthcare, industrials, technology, utilities, kind of all adds up to the S&P 5, but you can buy, trade, short, whatever you like to do, any piece of the S&P 5.
These have been around for how long?
We were really the first sector product in the marketplace. We launched in 1998. We're approaching 1,000 ETFs out there today. I think we were number 25 to 34. So we were early on. We were the first ones to go from kind of the broad-based indexes that were out in 1993 through 98. And in December of 1998, we launched Sector SPDRs.
So just in these 9 sectors SPDRs, you have about $35 billion under management. Is that right?
That's correct. Yeah, we have grown quite a bit in the last few years. Not only, $35 billion in assets, but we'll trade 200 million shares a day. So when you look in the sector space, we have the lowest expense ratio, 21 basis points, the tightest spreads with, 200 million shares a day trading. All 9 trade with penny-wide spreads. And really, from an institutional investor perspective, the place where they'll go in the sector space.
Sure, because that's where all the liquidity is. Let's talk about money flows, because I know this is one of the things that you're keen on. If you take the 9, and then what we're going to be discussing, folks, is where the money is flowing today and how to maybe use that to your advantage in terms of trading. But go ahead and get into that a little bit. Maybe what you've seen historically like a year ago versus what you're seeing right now.
Well, what we see, again, I mentioned earlier that we have a strong institutional presence in our products, and I think that the sector SPDRs may be a little bit different than traditional mutual fund flows. When, people look at mutual fund flows, they look at it almost as a contrary indicator. If the money's going there, it's late. I would make the case that our stuff is quite different, that when you see the type of flows that we see, and we're talking, billions of dollars each week that could move from one sector to another or in and out of the funds overall. It's the professionals that are coming in early and moving this type of stuff. What we're seeing over the last few months is really quite different than we saw a year ago. A year ago, we were seeing flows into kind of your defensive sectors like staples and healthcare and things like that, utilities. In the last few months, and really basically all year, the industrial sector has led the charge in terms of flows that we're seeing and performance of that sector for that matter. And I think if you're a Dow theorist, that's really kind of interesting stuff. When you look at the industrials leading the pack, and then you take a look at the other sectors that we're seeing good flows and good performance, it's kind of early cycle sectors like consumer discretionaries, technology coming on recently, sectors like materials and energies. It's kind of classic early cycle stuff that investors are playing in economic recovery, and these are the sectors that you go into at this stage.
So what's leading the charge?
From a performance perspective, year to date, you have consumer discretionaries up over 16%. You have industrials up almost 16%. And I think what may be even a little bit more interesting is the last 3 months. So as we came through the summer, we pulled into this nice market that we're in today. You have 5 sectors that are up in double digits in the last 3 months. And again, your early cycle sectors, tech, materials, industrials, energy, discretionaries, all up 10% plus in the last 3 months. And from a flow perspective, it's confirmed by money that we're seeing come in. I would say that one thing that is noticeable in the last couple of weeks, 2, 3, 4 weeks, is the recent flows into technology, which we really hadn't seen most of the year, but definitely looks like some money's coming into tech, and you're seeing some good earnings come out of the sector as well.
From what you're able to see, where is the money coming out of, going into? Where's the switch from to?
Well, there's really 2 sectors that are lagging this year in our space, and financials being the largest. XLF is the financial sector SPDR, net redemptions of about 80 million shares this year. So it's a significant outflow of money. Now, you can look at it 2 ways and say that we're losing money, people are losing interest in financials. I don't really think that's the case. I think that what people use ETFs for in general, in some cases, is instead of picking a single stock, I'm going to buy the basket of securities. And if it's really volatile, let me just buy that basket until I can figure out and dig deeper and figure out some individual names I want to own. I think we're seeing some of that in the financials. I think that the craziness that we've seen in the sector, that the move for a lot of people is, let me buy XLF. And now, as it's kind of settling in a little bit, you're starting to see people maybe buy individual names names a little bit more than they did in the past. And I think that's contributing to our outflows on XLF. So it's really the one sector that we're seeing money come out of. The second one, which I think is very interesting, is healthcare. That with everything that we've seen in the healthcare space from a political perspective, we see no money coming in. In fact, we see money coming out of the sector.
Really?
It seems like a lack of interest in that sector in an environment where you would think it should be, right? I mean, with everything that's going on and all the political unrest in around these companies and around every bill and everyone's focused on, we have outflows. So, if you're looking at two sectors, financials I can explain. Healthcare, I'm really a bit of a loss for why we don't see more action there. Some of those stocks are cheap.
There are subsectors to these that also are in spiders like financials, where there's KBE, the bank ETF, and the regional ETF, and the insurance, and so forth. Are you able to watch those, even though they're not part of your 9, to see how that plays with XLF, for example?
I don't see that as much because the 9 is really the only products that I control, but I do watch those flows, and they trade a lot. You'll see the regional banks, money comes in and out very quickly. You see news break on mortgage-related activities, and money may come in or out. You'll see short interest spike in some of those products. So they are clearly vehicles that professional investors move quickly with, both long and short, and when there's an event in the marketplace, it seems like that's where it goes first. And again, as additional work is done, they drill down to individual securities that may be part of that basket.
All right, let's talk tech once again. You have XLK as one of your 9. I don't know what the comparison is, but most would say the Qs are certainly the most visible of that sector. And of course, we've been pointing out for some time, and I've been talking to the NASDAQ, I don't know how many times, about why 20% of the index is weighted towards Apple, but that throws that off. XLK is more reasonably balanced in terms of if you would approach tech, you might approach it without that overweight in one company. But can you speak to that a little bit?
Yeah, I think there's a couple things in there. One is XLK is made up of the 85 components in the S&P 500 that are either technology or telecom. So a stock like AT&T or Verizon also included in XLK. The one thing before we even get into the Apple piece of it is that XLK is pure tech and telecom, where QQQs, or should I say QQQQ, is not a pure. I mean, it's a proxy for tech, but the reality is that, I don't know where it is today, maybe 60-65% technology, and then everything else is part of the NASDAQ 100. Could be consumer discretionary, could be a bunch of other things.
Right.
XLK is a much purer play on technology. In terms of weightings, again, all we do is take the S&P 500 components and put them together, and there are 85 stocks here that are market cap weighted. Now, Apple is still the largest component here. The stock has done so well that the weighting is now 11% of the overall product, but then it's followed by Microsoft and IBM, AT&T, Google, Cisco, Intel, Verizon, Hewlett-Packard, go down the list from there. Then again, there are 85 companies that make it up. You still have the top 5 that have 30-35% of the weighting of the overall fund, but that would include Google, so you get a little mix with Apple, Microsoft, IBM, AT&T, and Google, and then again the other 80 that follow after that.
As goes Apple, so go the Qs generally. A lot of people just don't know this, particularly in the retail area, just don't know this weighting issue, which I think is important for them to know for their approach to tech. The Chinese say even the monkey can fall from the tree. Obviously, Apple's overowned, or perhaps in everybody's portfolio, so if things would ever turn around there, it would be a kind of a shock to people. That said, I did want to ask you a little bit about XLY, Consumer Discretionary ETF, which to me always was kind of oddly weighted, even though you have nothing to do with that in terms of the index makeup. But it was always strange to me the constituents weight with Coca-Cola or something, or McDonald's. Or most people would think of consumer discretionary as retail.
Right. Our entire product lineup is based on the S&P 500. So we take the S&P sectors, which are known as GIC sectors, Global Industry Classification System by S&P, and basically follow that. And the products, the SPDR will be tracking the index, which in this case would be the Consumer Discretionary Index, made up in this case of the 81 consumer discretionary stocks in the S&P 500. Now, what's different about this is that it's really not a pure play, that you end up with a McDonald's, as you mentioned, and then a Ford Motor Company, and then Time Warner, a cable company, so it's really designed, again, I mentioned earlier, kind of these early cycle types of sectors. It's where are people spending their discretionary income? Where are they buying? And I don't know if McDonald's is really, as you have more discretionary income, are you going out to McDonald's more or a higher-end restaurant? I don't know, but that's the purpose. The purpose in this broad classification is one of a bunch of retailers, but in addition to retailers, your discretionary items like, will I buy another car? Or like, will I add another, cable box
right.
to my house? Or Starwood hotels and resorts, will I be on vacation more and spending some money that way? So it really is this collection of companies that if the economy is improving and people are spending more money, that this is a sector that should do well. It's not a pure play like energy, where if the price of oil goes higher in the energy sector, all those stocks tend to do well. This is kind of a hodgepodge of a bunch of different groups, but the underlying theme there is if people are spending more money and spending discretionary income, all these companies are kind of connected that way.
They're eating their dollar meals in their designer kitchens.
In their new cars.
Yeah. So maybe they'll go to Whole Foods instead if things get better.
That's right.
All right. Well, look, Dan, thanks so much for being with me. It's been very helpful, and hope folks understand what's going on, and I think you've done a lot to inform them. So once again, thanks for being with me. Dan Dolan of Select Sector Spider Trust.
Thank you.